All right, today we're doing something really interesting. We're going to take a look at Broadcom, a true giant in the tech world. But here's the twist. We're not just looking at the usual Silicon Valley metrics. Nope. We're putting it through the ringer using the timeless principles of one of the greatest investors ever, Warren Buffett. It's kind of like old school value investing meets new school tech. Let's see how it holds up.
First things first, just look at this number, 18,000%. Let that sink in. I mean, to put that into perspective, if you had put 10 grand into Broadcom 15 years ago, you'd be sitting on over $1.8 million today. That is absolutely the kind of return that can change your life. But as we all know, what happened yesterday doesn't tell you what's going to happen tomorrow, and that's exactly why we're doing this Warren Buffett way checkup. It all boils down to two and only two really simple questions. First, is this a genuinely wonderful business? And second, can we buy it at a fair price? That's it. That's the whole game.
Okay, so let's tackle that first big question. Is Broadcom what Buffett would call a wonderful business? Before we even glance at the stock price, we have to understand what we're actually buying. This is the bedrock of the entire philosophy.
So what does he even mean by a wonderful company? Well, think of it like this. You're looking for a strong castle that's surrounded by a really wide, deep moat filled with crocodiles. The castle is the business itself, and that moat, well, that's its competitive advantage that keeps all the competitors out. We're on the hunt for a business that isn't just making money now, but has what it takes to make money for years and years to come.
So let's get into the numbers. This right here is Broadcom's return on invested capital, or ROIC. You can basically think of it as a grade on how good the company is at turning its money into more money. And at over 18%, yeah, Broadcom is definitely an A student when it comes to efficiency.
And if you're a shareholder, well, the picture gets even better. This is the return on equity, and it's over 31%. Honestly, that is a staggering number. It tells you that Broadcom isn't just a company. It's a cash-generating machine for the people who own it.
But here, this is where the real magic happens. This chart shows us that Broadcom's profits, its actual bottom-line earnings, have been growing more than twice as fast as its sales. Now that is a huge telltale sign of a company with a serious competitive advantage, and it's exactly the kind of thing we're looking for in this checkup.
So after our first big check, the verdict is pretty clear, right? The numbers are all telling the same story. Broadcom is an incredibly efficient, highly profitable business. It is absolutely passed the wonderful business test with flying colors.
But, having a wonderful business is only part one of the story. Now we need to see how that business treats its owners, us, the shareholders. So let's dive into part two of our checkup.
Okay, look at this, 15. That is the number of years in a row that Broadcom has given its shareholders a raise by increasing its dividend. 15 straight years. That kind of consistency says so much about the company's stability and its commitment to rewarding the people who own a piece of it.
And we're not talking about tiny, symbolic increases here. We are talking about the dividend growing at over 12% a year, consistently. Think about what that means. If you owned the stock 5 years ago, the income you're getting from it today has more than doubled. That is the incredible power of a shareholder-friendly company.
Okay, so let's recap. We've got a wonderful business, and it's fantastic to its shareholders. Sounds like a slam dunk, right? Well, not so fast, because as any value investor will tell you, even the greatest company on earth can be a truly awful investment if you pay too much for it. So now we have to talk about the price.
And this is such a crucial distinction to make. See, the business is the engine, and the stock is just the price tag on the engine. You might have found a high-performance V12 engine, but if the sticker price is for a private jet, it's just not a good deal.
And that brings us to Buffett's #1 golden rule. Always invest with a margin of safety. What's that? Well, think of it like a bridge. You want to make sure the bridge is rated to hold a 10,000-pound truck, but you only ever drive a 5,000-pound truck across it. That extra capacity? That's your margin of safety. It protects you if things go wrong.
So first, let's look at the price tag. At the time of this analysis, one share of Broadcom is going to set you back just over $422. That's the market price. Now let's see what our checkup says it's actually worth.
And here it is, the moment of truth. Based on a discounted cash flow analysis, which is really just a fancy way of estimating all the cash the company will make in the future, we get a fair value of about $303. And yeah, right away, you can see the problem, can't you?
That leaves us with a negative margin of safety of almost 40%. Let me say that in plain English. The stock is trading for nearly 40% more than what our model says it's intrinsically worth. And for a value investor, that is a huge red flag. It's the cardinal sin.
So, where does that leave us? It's a classic puzzle. On the one hand, we have this amazing, wonderful business. But on the other hand, we have what looks like a dangerously expensive stock. This right here is the ultimate investor's dilemma.
Let's just lay it all out there. In one corner, we have the business, a true champion of profitability, efficiency, and shareholder returns. And in the other corner, we have the stock, a heavyweight contender with a sky-high price tag and a negative margin of safety. It is the textbook definition of a great company at a not-so-great price.
I think this analogy just hits the nail on the head. Imagine you found your absolute dream house. It's in the perfect neighborhood, great schools, everything. But the seller is asking for 40% more than what it appraised for. What do? Do you overpay, hoping the neighborhood gets even hotter? Or do you walk away and wait for a more reasonable price to come along? That's the exact question investors are facing with Broadcom right now.
So in the end, our Warren Buffett weight check doesn't really give us a simple yes or no answer. Instead, it leaves us with a really fundamental question, one every single investor has to wrestle with. What premium are you willing to pay for undeniable quality? In a market that seems to demand perfection, is there any price that's too high for a truly wonderful business? That, my friends, is the billion-dollar question you have to answer for yourself.